So 2020 has been a little bit crazy. It's not just affected our daily lives either. If you're an investor, 2020 has probably freaked you out quite a bit. You might be wondering, should I sell all my stocks now before it's too late? Is now a good time to get into gold, or is that opportunity already gone? Are bonds safe? I mean, is cash even safe? If you're feeling confused, don't worry, you're really not alone. So I've been trying to research a lot of this stuff to try to get my own head around things. And in this video, I'm going to share my research and my thoughts with you. I'm not a financial advisor, and this isn't financial advice. I'm just a regular guy researching this stuff. And like I say, it's just my personal research as I'm trying to understand things for myself. Okay, so we all know why the stock market and economy tanks near the start of this year, so there's really no point rehashing all of that. What's really been interesting to follow is the USA's central bank, the Fed, and how they've attempted to support the economy and in turn the stock market. If we look at the American stock market, we can see that it hit a peak in late February of this year and then spent just over a month consistently dropping day after day until it bottomed out on March 23rd. So why March 23rd? Well, this was the day that the Fed announced they would do whatever it takes to support the economy. They would begin printing vast sums of money, and most interestingly, they would lend some of this money directly to companies. Now, the Fed has printed money in the past, but there are two things which are really different this time around. For example, if we look at 2008 all the way to the end of 2012, that's a 4.5-year window on the screen. The amount of money printed in that time period was just over $2 trillion. If we fast forward to today, we can see that in 2020 alone, nearly $3 trillion has been printed. So the Fed has printed money before, but never on this kind of scale. And the second big change is that the Fed is loaning money directly to companies by purchasing their bonds, which is another drastic step that they have never done in the past either. With the Fed promising to act almost like a backstop for the stock market and providing such rapid and intense stimulus, the market quickly rebounded. While investors may have still had some fears about the economy, the Fed stimulus was so powerful that investors really regained confidence in the stock market and then they piled back in. So you've probably heard the term, don't fight the Fed. Well, the Fed are carrying out such unprecedented levels of stimulus that investors decided to bet with the Fed. In other words, they bet on the stock market rising. And of course, we saw a flood of retail investors at this time as well, who ended up buying the dip, with many using their stimulus checks. Now, the question is, what does all of this mean for us? Will the stock market continue rising? Over the course of this week, the stock market has been especially volatile. So maybe this is an indication to sell. Well, let's look at a few indicators and we'll try to piece this together in quite a simple, easy to understand manner. So the first indicator we'll look at has been described by Warren Buffett as probably the single best measure of where valuations stand at any given moment. What you basically do is you take the value of the country's largest stocks and divide it by the GDP of the country. Or in simple terms, you're trying to understand how well the stock market is doing in comparison with the economy. For example, if the economy is dropping but the stock market is rising, that's obviously more concerning for an investor than the other way around. So here's the chart and I'm going to talk you through it. So we can see the average labeled on the chart at just above 0.8, but other analysts might use 1 as the key number for modern times, so let's go with that. Basically, if the number drops below 1, it means that the economy is performing well, but the stock market isn't so much, and that could actually be seen as an indicator that it's a good time to buy. However, when the number rises above 1, it means the opposite. The economy is not performing well, but the stock market is still somehow rising. Now, we can see what happened when the value rose too high in 2000 and again in 2007. Well, the value today sits at around 1.7, the highest level it has been at any point on our chart. So it's pretty clear that this indicator is telling us that the stock market, based on this at least, could be overvalued. Next, we have the Schiller Pe Ratio. Remember our last indicator was a comparison between the economy and the stock market? Well, this indicator, to keep it simple, is essentially a comparison of how much money a company makes versus how much they are worth. The simplest way to really describe this is, imagine you're going to buy shares in a company. You're buying the right to the future money that that company will make. So if a company is making, let's say, $1 per share and you're not feeling so optimistic about their future, maybe you're only willing to spend $10 on a share. If, however, you are really optimistic about a company and its potential for growth, its potential to make more money in the future, maybe you'd be willing to pay twice as much per share, $20. Even though the company makes the same amount of dollars per share, you're actually happier to pay more because you're more optimistic about the company's future. If we extrapolate this out over the course of the whole stock market, we can kind of get an indication of how optimistic investors are about the general market. Well, this chart with the Schiller Pe Ratio shows us exactly that by using the inflation-adjusted earnings from the previous 10 years. The key thing to really remember here, as with just about all indicators, is that on a long enough time frame, things usually trend back towards the normal. That means if the value is low today, it will generally trend upwards in the long run. If the value is high today, it's generally going to trend downwards in the long run. So the value today is currently just over 31, while the historic average is nearer to 16. So what does this mean? It means the companies in the stock market are being valued twice as high today for every dollar that they earn compared to the historic normal. Or in other words, the stock market is indicating to us that people are twice as optimistic today as they normally are. Now, I don't know about you, but this doesn't sound quite right to me. And that's why it could be argued that the ratio might potentially trend downwards over the coming years. And of course, that is negative for the value of stocks. So there you go, 2 negative indicators. The stock market is going to crash. I told you it was nice and simple. There we go. The thing is, anyone who tells you that predicting the stock market is easy, making money is easy, or really anything on the internet along those lines is normally feeding you a bunch of rubbish. The truth is, it's not as simple or as easy as that. You see, do you remember earlier when we talked about the Fed printing a lot of new money and some of that new money feeding its way into the stock market? Well, that wasn't the only side effect. You see, as the Fed continues to print more money, they also increase the likelihood that the dollar will fall in value. And how exactly does that impact stocks? Well, obviously stocks, like just about everything else, are priced in terms of their local currency. For the US, of course, they are priced in terms of dollars. So as the dollar potentially falls in value, which is something we've seen over the past few months, the stock market could rise in value. But interestingly, this isn't just a stock market either. We've witnessed an interesting trend recently that I've been highlighting in some recent videos, which is that numerous markets are simultaneously climbing at the same time. Stocks, bonds, and commodities have all at the same time had a very impressive second quarter. And usually you'd find that these markets aren't particularly correlated. In fact, you'll often find that maybe as one rises, another may fall. The fact that all of them are rising together could actually be because the dollar is simply losing value against each of them. On top of this, the other effect of printing money is that it's made holding cash less appealing. Usually maybe you'd hold some cash to one side to buy the stock market dips. But is it really worth trying to do that today? With cash falling quickly in value and the stock market generally rising, does it make sense to hold cash in hopes of a dip? Now, of course, everyone should hold a 12-month emergency fund in cash. This is something I've spoken a lot about in the past. But for this, we're really talking about investable cash. Well, if the answer is no, it doesn't make sense to hold cash on the side, then investors have effectively been incentivized to invest their money in the stock market instead of holding a portion in cash. And the same goes for bonds too. Ray Dalio has been outspoken in recent times in saying that he believes bonds are really a bad investment. Why exactly? Well, number one, interest rates are extremely low. I mean, do you really want to hold a bond that pays you just 1% per year? And number two, a bond is simply a claim on future cash. So for example, let's say you buy a bond for $100 and it offers you a 3% interest rate. Well, that is essentially buying something that promises to pay you $3 per year. As Dalio says, why would you want to buy something which entitles you to future cash when cash is being printed like crazy? So while many investors might turn to cash and in particular bonds during more risky times like this, neither actually looks so attractive at the moment. So if investors don't want to store their money in cash or bonds, where do they turn? Well, you might argue that the stock market looks risky, considering everything that's going on with the economy at the moment. To be honest, this is generally how I tend to think, but someone else could also argue validly that because cash and bonds aren't looking the best either, then there really isn't a safe option out there. As a result, even though the stock market is incredibly risky, so is just about every option to some extent, and at least the stock market has the potential to offer high returns, unlike bonds and cash. To add to this, the Fed have recently discussed shifting their inflation target. Historically, inflation has been targeted at 2% each and every year. Some years they overshoot 2%, other years it's under 2%. But each year, they simply forget what happened the previous year and they just target 2% for the current year. Well, recently they've discussed having 2% as an average inflation. So, for example, one year might have, let's say, 1% inflation. Well, usually, again, you just put that to one side and you'd aim for 2% the next year regardless. However, because they're aiming for 2% average, they would now instead aim for a higher target of 3%. Well, inflation over the past decade has been below 2% on average, and that means that the Fed might be intentionally targeting higher inflation over the next couple of years. Again, this makes cash and bonds weaker as an investment, and so more investors may end up turning to the stock market. So I know at the start I said that I would make things nice and simple to wrap your head around, but the truth is, when it comes to the stock market, it is confusing. It's not simple and it doesn't follow easy to understand rules. Quite frankly, if anyone is telling you anything different, stay well away from them. Here's the thing, and I'll tell it to you straight. I think the stock market, to be honest with you, looks like a giant pile of cards being stacked on top of each other. I think the Fed can only keep printing money for so long until they risk damaging the dollar's status as the world's reserve currency. When they eventually stop or begin to slow down, or maybe even well before this date, the market has to at some point crash back to some level of reality. But at the same time, there were many investors who said exactly what I just said back in 2008-09, and they missed out on one of the best bull markets of all time in the next decade. So that's why, as much as I may have my beliefs, I think there's really just 6 key things to remember, 6 key takeaways from this video. Number 1, have a 12-month emergency fund in cash. Even if you don't like cash, as I personally don't, it's always a good idea just to have a safety net. Number 2, timing the market is next to impossible. Number 3, if you have a strategy, you should have already planned for turbulent times, so just stick to that strategy. Number 4, diversify across different asset classes and across different countries. Number 5, in times of money printing and stock price inflation, holding real assets which can't be printed or inflated is nearly always a good idea. And finally, number 6, just take a breath. Don't watch prices every day unless you plan to actually do something with your investments. Because what's the point in seeing the price go up and down if you're not going to do anything anyway? It's only going to dangle a carrot in front of your emotional side that makes you want to act and stray away from your plan. I'd love to know what you think, particularly about holding assets which can't be inflated. Things like gold, silver, Bitcoin, real estate, etc. Let me know in the comments your thoughts. And of course, before you go, check out this video up here. Thank you for watching.